Hello, how are you doing today? I hope you're doing great wherever you are, and ready to dive into our new Capsim Round 1 video. I strongly believe that if you follow our Capsim guide for making Capsim decisions, not only will you be the best in your class, but you'll rank among the best in the world. By Capsim Round 7, you'll even have the chance to score as high as 995 points. If you're eager to learn at lightning speed, just follow the link in the video description. Need help with your Capsim simulation, situation analysis, or any other Capsim tasks? We're here to make it easy. WhatsApp us. You'll find the link in the description. Also, don't forget to subscribe and give our video a thumbs up. Your support helps us keep bringing the best strategies for Capsim success. Now, let's get to making those Capsim decisions. From your dashboard, click on Start Capsim Round 1. Select a decision, and dive straight into research and development. But first, let's understand the available reports. Click on Reports and check out the front page. The first section shows financial statistics. These are key numbers that measure your company's performance. Currently, 6 companies make up this Capsim industry: Andrew, Baldwin, Chester, Digby, Erie, and Ferris. Let's get started. All the Capsim companies have the same starting statistics. For example, the return on stock for all of them is 4.1%. The asset turnover is 1.05, and the return on assets is 4.4%. This is because we all begin at the same level. And before we start competing, we'll see identical results in round 0. But don't worry. Afterward, we'll start to see differences in these financial statistics as competition heats up. In the second section, you'll find market share information. Right now, all companies, including us as Andrew, Baldwin, Chester, and Digby, have the same market share of 16.67%. The stock market summary provides a breakdown of stock prices, share changes, market capitalization, book value per share, dividend yield, and the price to earnings ratio. Exciting stuff, right? Next, we get into the financial summary. This section includes cash flow statements, balance sheet surveys, and income statement surveys, giving us key insights into company performance, like profits, sales, and costs. Then, we move to production information, which gives detailed data on the products each company offers. You'll see plant automation levels, capacity for the next round, and plant utilization. It also covers the product performance and size, plus the age of each product. This info will be super useful when comparing ourselves to our competitors and making smarter decisions. Don't overlook the market segment analysis either. This section shows what customers are looking for in different segments. In the traditional segment, for example, age is the most critical factor, with customers preferring products around 2 years old. You can scroll down to check out the data for other segments like low-end, high-end, performance, and size. Further down, we have human resource information. Here, we see expected wages, benefits, profit sharing, and annual raises. Crucial when comparing ourselves to our competitors. If other companies offer better compensation packages than us, we may face higher turnover rates, which can be costly due to hiring and training expenses. Finally, we get to the TQM, Total Quality Management Summaries. This section provides insights into TQM initiatives. Last year, no company used TQM strategies, and I don't think we'll see any company using them in Capsim Round 1 either, since these strategies might not become available until Capsim Round 3. That's a report we'll keep referring back to as we make decisions in Capsim Round 1. We'll pause on it for now and return to it later. Another key Capsim report is the Industry Condition Report, which shows how customer preferences for performance, size, and reliability will shift as we move through the rounds. Let's dive in and start making some smart decisions. The Capsim Industrial Condition Report gives us information about how changes will occur over time. For example, we can see segment centers for each Capsim round, starting from Capsim Round 0 for traditional, low-end, high-end, performance, and size, all the way to Capsim Round 8. As we scroll down, we can also see drift rates for each market segment. These drift rates show how far customer preferences are from the segment center. Therefore, this is the same as drift rates. For example, in the traditional segment, the drift rate is positive and negative 0.7 for its performance and size respectively. On the low end, it's 0.5. On the high end, we have positive 1.4 and negative 1.4. In the performance segment, it's positive 1.4 and negative 1.0. While in the size segment, it is positive 1.0 and negative 1.4 for the performance and size respectively. We will use these drift rates for our performance and size coordinates in R&D during Capsim Round 1. This will help us make informed decisions. Now that we have the drift rates, we can update them in our Capsim spreadsheet. We can call this Capsim Excel spreadsheet. Before updating, we should name our products: Able, Acre, Atom, Aft, and Agape, to avoid confusion. Able is for traditional, Acre is for low end, Atom is for high end, Aft is for performance, and Agape is for size. We have entered the drift rate for our first product, Able. Now we will find the performance and size coordinates for Capsim Round 0, which will help us determine the Capsim Round 1 performance and size coordinates for Able, our traditional product. When reviewing the traditional segment report, we should focus on what customers want in their product. For example, 47% of the market prefers an age of 2 years, which we manage in the research and development section. The ideal position controls 21 to 25% of the market and is also managed in R&D. Finally, the reliability of 14,000 to 19,000 can also be managed in the research and development section. This influences 9% of the market, with a drift rate of 0.7. We see that in round 0. We had a performance of 5.5 and a size of 14.5. We can add these to our Capsim template. We have new performance and size coordinates, 6.2 for performance and 13.8 for size. We can update these in the R&D section by increasing the performance to 6.2 and reducing the size to 13.8. Customers are also looking for reliability between 14,000 and 19,000, which influences 9% of the market. Let's start with 18,500 instead of 19,000 and increase it gradually. The revision date for Able will be July 25th, 2025, which is the current Capsim year. At that time, the product will have an age of 1.8, which is close to the required age of 2. Let's move to our second product, Acre. In the low-end segment, price is the most important factor for customers, influencing over 50% of the market. The second most important factor is the product's age, with a target of 7 years. We will not change the performance, size, or reliability of Acre to allow it to age properly and reach the desired 7 years. This is important for 20% of the market, which is significant compared to other factors. In the Capsim Industry Condition Report, the drift rate for the low-end segment is 0.5. We're not changing anything. We are maintaining the performance and size coordinates at 3 and 17, as calculated by the Capsim template. The new coordinate remains the same as in Capsim Round 0. The next product we're looking at is Atom, which belongs to the high-end market segment. The drift rate here is positive 0.9 and negative 0.9. So let's enter those values into our Capsim Excel template. With these drift rates ready, we'll now check the high-end market segment report. In this segment, the most important factor for customers is the ideal position. This explains the significant drift rate. Our goal is to ensure Atom performs well and stays small enough to meet high-end customer expectations. Now, the age requirement of 0.0 is tough to achieve, as Atom's current age is 1.7, and by the end of the year, it'll reach 2.7. Even after adjustments, the age will only halve, meaning it'll still be far from 0.0. But don't worry, this is a challenge for the entire industry, so no company will attain the 0.0 age for existing high-end products. Reliability is another key factor, influencing 19% of the market, with a range from 20,000 to 25,000. we'll go to the maximum reliability of 25,000. Looking at Atom's current performance and size coordinates, 8 and 12 from round 0, let's update these in our template. For Capsim Round 1, Atom's new performance and size coordinates will be 8.9 and 11.1. With the reliability set to 25,000, we see after recalculating that Atom is slightly below the segment center on the perceptual map, but it's close to the ideal position for the high-end segment. We're right on track. Now, onto Agape. Let's start by checking the industrial condition report for the drift rates. For Agape, the drift rates are positive 0.7 and negative 1.0. Let's enter these into our Capsim Excel template. Next, we'll head over to the size market segment report. In this segment, the ideal position is the most critical factor, influencing 43% of the market. After that comes age, with a target of 1.5, and reliability, which needs to fall between 16,000 and 21,000. We'll focus on hitting the ideal position first. Agape's performance and size coordinates from round 0 are 4.0 and 11.0 respectively. After plugging those into our Capsim Excel template, the new performance and size coordinates for Capsim Round 1 are 4.7 and 10.0. We'll set the reliability to 19,000, and with these changes, Agape's new age will be 1.6, which is close to the target age of 1.5, meeting customer expectations in the size segment for ideal position, age, and reliability. That wraps up research and development for now. But before we jump to the next department, let's look at some other important factors. Material cost varies across different products. For instance, Acre currently has the lowest material cost and will continue to do so in Capsim Round 1, mainly because the reliability requirement in the low-end market is low, at 14,000. In contrast, Atom and Aft have higher material costs due to their demanding high-end performance and reliability needs. Customers expect sensors that are smaller and more efficient, which naturally raises material costs. Agape's material cost is still manageable, although it's expected to rise slightly in Capsim Round 1 because of the improvements in performance and reductions in size. Lastly, let's talk about product age, which is affected by changes to performance and size. For example, when we made changes to Able, its age was cut in half, from 3.7 to 1.9. This happens depending on when the changes are applied during the year, and after the change, the product continues aging normally. That's how we calculate and adjust the new age for our products, ensuring we're always one step ahead in Capsim. Now, let's dive into marketing, one of the most crucial aspects of any business strategy. In this section, we're focusing on two main parts: price and forecast, and promo and sales. Personally, I prefer starting with promo and sales because the decisions made here help lay the foundation for the forecast. Plus, with our trusty Capsim forecasting Excel template, generating accurate forecast values for each product is a breeze. Promo budget breakdown. Let's begin by breaking down the promo budget. Capsim gives us 5 media categories to work with, and it's all based on important concepts like reach and frequency. Reach refers to the percentage of customers exposed to our ad, while frequency measures how often each customer sees it. The bigger the budget, the higher the frequency. But here's a key tip. Even the best media needs a balanced mix to maximize reach, and diminishing returns come into play, meaning at some point, extra spending won't bring much more awareness. Example time. Imagine having a $500,000 print media budget. Your team will spread that out strategically across magazines and trade journals to get the best bang for your buck. Now, let's talk print media specifically. It's super effective for certain segments, especially traditional and low-end, and fair for size. But here's the catch. Spending over $700,000 won't give us much more value, so we'll cap it there. For traditional, since print media is highly effective, we'll allocate $700,000. For the low-end segment, we'll also allocate $700,000. For high-end and performance, where print media isn't as strong, we'll cap it at $500,000 each. For size, where print media is rated as fair, we'll go with $600,000. Direct mail strategy. Next up is direct mail, which performs well in traditional and low-end segments, is fair for high-end, and is less effective in performance and size segments. Spending beyond $800,000 here doesn't add much, so for traditional and low-end, we'll max out at $800,000. For high-end, where it's only fair, we'll go with $500,000. For performance and size, which are less responsive to direct mail, we'll stick with $300,000 each. Web media approach. Now, let's shift our focus to web media, which varies in effectiveness across segments. It doesn't work as well for traditional and low-end markets, but performs fairly well in high-end and excels in performance and size segments. The spending cutoff here is $500,000. For traditional and low-end, we'll spend $200,000. For high-end, we'll allocate $300,000. For performance and size, where web media shines, we'll go with $500,000 each. Email and trade shows. For email marketing, it has a similar pattern to web media. In traditional and low-end, it's less effective, fair for high-end, and strong for performance and size. Traditional and low-end, $300,000. High-end, $500,000. Performance and size, $600,000 each. Lastly, let's touch on trade shows. These are rated as fair for all segments except for size, where the impact is lower. With a budget cap of just $300,000, we'll max it out for all segments. Recalculation time. After recalculating, here's where we stand. Able, traditional, $2.3 million. Acre, low-end, $2.3 million. Atom, high-end, $2.1 million. Aft, performance, $2.2 million. And Agape, size, $2.3 million. Now, we'll take these totals and enter them into our Capsim Excel forecasting spreadsheet for projections. Breaking down the media category budgets, we get print media, $700K, $700K, $500K, $500K, and $600K. Direct mail, $800K, $800K, $500K, $300K, and $300K. Web mail, $200K, $200K, $300K, $500K, and $500K. Email, $300K, $300K, $500K, $600K, and $600K. And trade shows, $300K for all products. That's it for now. If we compare the promo budgets, everything matches up between the Capsim spreadsheet and our Capsim Excel template. We're on the right track. Now, let's shift gears and move into the sales section, a crucial part of driving revenue. We'll break this down into 3 key components: outside sales, inside sales, and distributors. First, let's clarify what each of these entails so we can make informed decisions. Outside sales involves direct, face-to-face interaction with customers, which is why we assign a specific number of salespeople and representatives for each market segment. Each outside salesperson comes with a cost of about $125,000, covering their salary, commission, travel, and support. It's important to note that beyond a certain threshold, additional salespeople won't yield increased benefits. So we must stay within the optimal number for each segment. Otherwise, we'll end up with unnecessary expenses. Inside sales. Now, let's talk about inside sales. This team handles existing customer relationships, manages leads from promotions, and runs customer support as well as your website. Each inside salesperson costs about $50,000. The golden rule here is not to exceed 30 inside salespeople per segment, because after that point, we experience diminishing returns on our investment. Distributors. Lastly, we have distributors, who each cost around $100,000 per year. While they're critical for some segments, employing more than 15 distributors per segment won't yield additional benefits, so we'll cap it at that number to avoid overspending. Segment-specific sales strategy. Now, Let's break down our sales strategy for each segment. In the traditional market, outside sales effectiveness is low. Inside sales effectiveness is medium, and distributors are highly effective. We'll assign 5 outside salespeople, 20 inside salespeople, and 15 distributors, which is the maximum number allowed. For the low-end segment, outside sales is medium, inside sales is low, and distributors are, again, highly effective. Here, we'll employ 8 outside salespeople, 15 inside salespeople, and 15 distributors. Moving to the high-end segment, outside sales shines the brightest. Moving to the high-end segment, outside sales shines the brightest, followed by inside sales, and distributors are the least effective. Thus, we'll hire 12 outside salespeople, 20 inside salespeople, and 8 distributors. In the performance segment, inside sales is the most effective, while outside sales ranks second and distributors come last. We'll go with 8 outside salespeople, 30 inside salespeople, the maximum, and 8 distributors. Finally, for the size segment, outside sales is key, followed by inside sales, with distributors being the least impactful. We'll assign 12 outside salespeople, 20 inside salespeople, and 8 distributors. Time for recalculation. With those numbers in mind, let's recalculate. We can now enter these values into our Capsim Excel template. For Able, traditional, 5 outside sales, 20 inside sales, and 15 distributors. For Acre, low end, 8 outside sales, 15 inside sales, 15 distributors. For Atom, high end, 12 outside sales, 20 inside sales, 8 distributors. For Aft, performance, 8 outside sales, 30 inside sales, 8 distributors. For Agape, size, 12 outside sales, 20 inside sales, and 8 distributors. Allocating time equally. Another important factor to consider is time allocation. This directs your sales force on how much time they should dedicate to each product. Since this is Capsim Round 1, we'll keep it simple and give each product equal time. That means we're allocating 20% of the time to each product. Projected accessibility. Now that we've entered the data, let's take a look at our projected accessibility. For the traditional segment, previous accessibility was around 54.3%, and now we expect it to reach 77%. In the low-end segment, we're moving from 39.9% to 69.2%. For high-end, it's an increase from 48.4% to 75.18%. In performance, we're jumping from 37.1% to 67.61%. Lastly, for the size segment, we're boosting accessibility from 51.8% to 70.75%. Awareness growth. We're also projecting some solid gains in awareness. Able will hit about 67.63%. The low-end product will reach 65.41%. Atom will grow to 63.44%. Performance will rise to 61.71%. And Agape will land at 61.81%. This awareness data is crucial for calculating demand forecasts, and we'll use it in our Capsim Excel template to fine-tune our projections for the upcoming round. Wrapping it up. That's all we need to cover for marketing. If you have any questions or need additional help navigating your Capsim decisions, feel free to contact us through the link provided. Now, let's hit recalculate and see the results. All right, let's dive into the second part of our marketing strategy, pricing and forecasting. This is where we really shape our product strategy for the next Capsim round using the insights and data we gathered from the previous one. Pricing strategy. First up, let's talk about pricing. We're going to keep things simple by using the price points from the last Capsim round. For the traditional product, the price in Capsim Round 0 was $28. And we're not going to make any changes there. It stays the same. For Acre, or low end, the price was $21. And again, no changes here. Atom was priced at $38. However, for aft, we're going to increase the price to $34.5. And we'll do the same for agape, raising its price to $34.5. Why the price increase? Let me explain why we are increasing the prices for aft and agape. The performance and the size market segments both have acceptable price ranges between $25 and $35. This gives us some flexibility to raise the price while staying within that range, which allows us to increase profit margins without upsetting our customers. Reviewing Capsim Round 1 sales. Now, let's review our sales from Capsim Round 1. In the traditional segment, we sold 999 units. In the low-end segment, we sold 1,763 units. Atom sold 366 units. Aft sold 358 units. And in the size segment, agape sold 314 units. These numbers give us a solid foundation to forecast future sales, and we've already calculated preliminary forecasts using our Capsim Excel template. Adjusting the forecast. Now, remember, we're increasing the price for aft and agape to $34.5. But when we forecast, we can't just rely on the benchmark prediction because it assumes that all our competitors will offer average products. We know better, right? Competitors may make smart decisions that can affect market dynamics, so we'll need to take that into account and do our own forecasting. Here are the updated sales forecasts for our Capsim forecasting template. Able is forecasted to sell 1,279 units. Acre is projected to sell 2,130 units. Atom is expected to sell 591 units. Aft is forecasted at 560 units. Agape is projected to sell 544 units. Now let's move into Capsim Round 1 production. We've already included some values in the Excel's template, such as forecasts and inventory levels. The unit sales forecast comes directly from the marketing department, and the inventory on hand consists of unsold products from Capsim Round 0, which will carry forward to the next round. Key production considerations. Production adjustments must account for several factors. Capacity, ensuring we don't overproduce beyond what our facilities can handle. Complement, balancing labor and resources to meet production needs. Accountable land policy, keeping within strategic constraints for production space. Another critical factor is time in the market. For example, if a product is introduced later in the year, let's say October, it will only be produced for 3 months. This significantly impacts how we plan the production schedule. Risk of relying solely on forecasts. It's important to note that basing production solely on forecasts carries risks. If demand exceeds our expectations, we may lose sales to competitors. To mitigate that risk, we'll produce a bit more than forecasted to cover additional demand. Here's the breakdown. For Able, we forecast 1,279 units in sales. So we'll produce 1,420 units to cover extra demand. For Acre, we forecast 2,130 units in sales, but we'll produce 2,200 units to cover demand and keep a safety buffer. For Atom, we forecasted sales are 591 units with 40 units in inventory. Initially, we planned to produce 550 units, but that's too low, so we're increasing production to 620 units. For Aft, we have 530 units in inventory and forecast 560 units in sales. Therefore, we'll produce 530 units and rely on the inventory as a buffer. Finally, for Agape, we forecast 544 units and have 62 units in inventory, so we'll produce 560 units to cover demand. Now, let's recalculate and make sure everything lines up with our plan. Margins and second shift production. Next, let's talk about margins and second shift production. Second shift production becomes necessary when the first shift can't meet the production schedule, even with 100% overtime. It's important to note that if some production lines are fully working overtime while others aren't, it disrupts the flow and makes it impossible to complete the schedule. Here's the rule. Once the first shift is fully staffed, second shift workers are added. If more support is needed, overtime is added to supplement the second shift. But remember, labor costs for second shifts and overtime significantly affect total unit production costs. The contribution margin is another key factor. It's the difference between the selling price and the total unit cost. Ideally, we aim for a contribution margin of at least 30%. Right now, products like Acre and Aft are struggling with margins below that threshold, which makes it hard to cover overhead costs. Moving forward into Capsim Round 2, we'll adjust prices and costs to ensure that margins reach at least 30%, allowing us to cover overhead and secure a decent profit. Physical plant adjustments. Let's take a look at the physical plant and consider our capacity needs. For Able, the first shift capacity is 1,800 units. In the traditional market segment, we only sold 961 units in Capsim Round 0. So we clearly don't need capacity for 3,600 units right now. We'll sell 800 units of capacity, leaving us with 2,000 units, which should be enough to meet demand through Capsim Round 4. For Acre, we won't buy or sell capacity in this round due to limited funds. But increasing Acre's capacity in the future is a good idea. The low-end market segment is growing rapidly, with demand expected to increase by 11.7%. Given that we're also boosting promo and sales budgets, we anticipate even higher demand from Capsim Round 2 onwards. We'll need to consider increasing Acre's capacity to meet this demand without relying on costly overtime. For Atom, in the high-end segment, we have a capacity of 900 units, but are only producing around 400 units. We don't need this much capacity, so we'll sell 350 units to free up resources. For Aft, our performance segment product, we're currently producing around 317 units. Again, this means we don't need as much capacity, so we'll sell some of it as well. Now, let's dive into automation ratings. Automation is assessed on a scale from 1 to 10. At level 1, skilled workers are essential for production, while at level 10, robots handle most of the manufacturing. For instance, with an automation level of 1, the labor cost per unit is typically around $12. This figure can vary based on labor contracts and the simulation year, but $12 is a common benchmark. As automation increases, labor costs decrease by approximately $1.2 for each point of automation. At an automation level of 10, labor costs drop significantly to around $1 per unit. Benefits of increasing automation. Clearly, increasing automation translates to lower production costs. At the highest level of automation, labor costs drop from $12 to just $1.2 per unit. This is substantial savings. For our product Able, which is in the traditional market segment, customers expect prices to fall over time. Price is a key factor for 23% of the traditional market segment, making it strategic to begin increasing automation early. This move will help cut labor costs and boost profit margins. Automation for different market segments. For Acre, labor costs are also crucial. Reducing these costs through automation is necessary to stay competitive. Similarly, for Aft, a product in the performance segment, controlling labor costs is critical. Customers in the segment demand high reliability, between 22,000 and 27,000. Achieving the maximum reliability of 27,000 will lead to high material costs, so reducing labor expenses will help balance the budget. We should consider raising the automation rating for Aft to level 5. This approach is also applicable to the high-end and size market segments. Investment and capital expenditure. We've calculated that our maximum investment capital expenditure is limited to funds from stocks and bonds, plus any excess working capital. We have $32,694 available, which we plan to use to increase automation ratings. This strategic investment will reduce labor costs and enhance profitability. Checking the complement. Now, let's review the complement. This term refers to the number of workers needed to complete production tasks. Currently, we need about 885 workers, and we're using 100% of our complement. If we only had 90% of the required workers, we'd need to rely on 10% overtime. Fortunately, this year we have the precise complement with 686 workers on the first shift and 199 on the second shift. AP lag and financial considerations. We won't be changing the AP lag from 30 days. Altering this figure could delay payments to suppliers and receiving payments from customers who buy on credit, potentially creating cash flow issues. Such problems might force us to take out an emergency loan, which we want to avoid. That wraps up our discussion on production. If you have any questions or need assistance with your Capsim project, feel free to reach out to us via WhatsApp, the link in the video description. Also, remember this video is part of a series of 8. Check the description for links to the other videos in the series. Now, let's dive into the human resources section. Currently, we have no decisions to make here as there are no options available. However, let's revisit some key details from last year and this year to understand our situation better. Workforce overview. Last year, we needed about 701 workers. This year, that number has increased to 885. We are currently utilizing 100% of our complement, meaning no overtime is needed at this moment. If we were working with only 90% of the complement, we'd require some workers to do overtime. But right now, all the workers are on the first shift, with additional hires for the second shift. Last year, we had 640 workers working on the first shift. This year, that number has risen to 686. For the second shift, last year we had 60 workers, and we are increasing this to 199 workers this year. Overtime was minimal last year, around 0.2%, and we are not using any overtime currently. Our turnover rate remains steady at 10%, meaning we're losing about 10% of our workforce to competitors. Last year, we hired 70 new employees, but this year we're bringing an additional 274 workers. Labor negotiations. Regarding labor negotiations, our current labor contract details are as follows. We pay about $21 per hour, with benefits amounting to $2,500, profit sharing at 2%, and an annual raise of 5%. However, labor demands are rising. They are now asking for $23.1 per hour. Benefits of $2,750, profit sharing at 2.2%, and an annual raise of 5.5%. Negotiation strategy. Our negotiation stance is to maintain the current terms. A hiring wage of $21 per hour, benefits of $2,500, profit sharing at 2%, and an annual raise of 5%. We cannot exceed the negotiation ceilings of $23.1 per hour for wages, $2,750 for benefits, 2.2% for profit sharing, or 5.5% for the annual raise. It's crucial not to offer the maximum of these ceilings, as it could strain the company's finances. Instead, provide a reasonable raise that will satisfy most employees without overwhelming the company. When it comes time to make this decision, likely around Capsim rounds 4 or 5, consider moderate adjustments. For example, you could propose increasing wages to $21.5, benefits to $2,550, profit sharing to 2.1%, and the annual raise to 5.1%. This approach demonstrates your effort to meet employees' needs while keeping the company's financial health in check. Remember, it's not feasible to meet every demand fully. Instead, aim for a balanced approach that maintains the employee's satisfaction while ensuring manageable costs. Now, let's turn our attention to the finance section. This area encompasses various decision-making opportunities, such as issuing or retiring stock, issuing dividends per share, borrowing money, or adjusting the accounts receivable and payable periods. However, our decision will depend on the company's current resources and needs. Since we're just getting started and our resources are limited, our immediate goal is to address the negative cash position of $28,670. Before diving into specific decisions, let's review the balanced scorecard to pinpoint areas that need improvement. Key metrics to focus on. 1. Profit. Profit is straightforward. To achieve the desired net income, you need to increase sales, reduce production costs, and manage overhead effectively. To earn full credit, aim for a net income of $7 million. Net income between $1 million and $7 million will earn partial credit. Our goal is to hit that $7 million mark for maximum credit. 2. Days of working capital. Full credit is awarded if your days of working capital fall between 30 and 90 days. Currently, we're at 35 days, which is within the target range. However, the negative cash position of $28,670 is impacting this metric, so we need to address the cash deficit to fully benefit from this measure. 3. Contribution margin. As previously discussed in production, maintaining a contribution margin of at least 30% is crucial for earning significant credit. Partial credit is given for a contribution margin between 27% and 36%, while full credit is awarded if it exceeds 36%. Moving forward, our target should be to sustain a contribution margin above 36%. 4. Stock price. By reducing production costs and maximizing sales, you will score full points for stock price. 5. Customer buying criteria. This measures how well your product meets customer needs in specific segments, such as reliability, ideal positioning, price range, and age requirements. Meeting most of these criteria will earn full credit. 6. Customer awareness. Controlled by your promotional budget, full credit is awarded if customer awareness exceeds 90%. The goal is to boost customer awareness to at least 90% to secure full points. 7. Customer accessibility. Similar to customer awareness, full credit is given if customer accessibility reaches 90% or higher. 8. Product count. This measures your ability to introduce new products and attract customers in specific market segments. To be viable, you need to capture 6% or more of segment sales. Not introducing new products will hinder your product count score. So ensure to innovate and launch new products to maximize this metric. Let's dive into the SG&A expenses. These refer to your sales, general, and administrative expenses as a percentage of sales. To earn full credit, your SG&A rate must fall between 7 and 20%. Keep your SG&A expenses within this range to maximize your score. Next, consider the employee turnover rate. This metric measures the percentage of your workforce lost to competitors each year, reflecting how well you retain your employees. For full credit, ensure your turnover rate is below 9.5%. This indicates a stable and satisfied workforce. In the balance scorecard, you'll find two key sections: Round 1 projected results and recapitulation interim results. These sections assess the cumulative impact of your decisions. For instance, our current market curve shows a modest score of 0.9 out of 20 because we're just starting out. However, by round 8, aim for a score close to 20 out of 20. Similarly, your sales averages should improve as you progress through each round. By round 8, achieving between 230 and 240 points would be an excellent outcome, considering we're at the beginning of this journey. Completing the finance section. Now, let's finalize our finance decisions. We will hold off on issuing dividends per share or retiring stock for now. Instead, we'll focus on issuing long-term debt to address our immediate cash needs and manage production effectively. As of December 31st, we're still facing a negative cash position of $11,689. To address this, we'll issue stock up to a maximum of $13,700. This adjustment will improve our cash position to $1,566, which is a decent starting point, but still not sufficient to completely avoid emergency loans. To further safeguard against potential emergency loans, We will also take on short-term debt of $3,500. After this adjustment, our cash position will rise to $4,841. This should be enough to cover any unexpected shortfalls if our demand forecast turns out to be overly optimistic. That wraps up today's session. For more insights, be sure to check out the other videos in this series. The links to Capsim Round 2 through Capsim Round 8 are available in the video description. If you need any help with your Capsim project, don't hesitate to reach out via WhatsApp. The link is provided in the description as well. Thanks for tuning in and have a great day.